Silver just dropped to around $75. And for many investors, that move felt like a collapse. Charts turned red, headlines turned negative, and sentiment shifted from excitement to fear almost overnight. But what if this isn't a crash at all? What if this drop is actually the final stage of a bullish reversal pattern, the kind that historically appears right before a major breakout? Because according to a growing number of analysts, silver's recent move isn't the end of the trend, it's the setup. And everything right now is revolving around one price zone, $74, the current price structure. As of mid-February 2026, silver is trading around $75. And on the surface, that looks weak compared to the recent highs. But when you zoom out and study the chart structure, a very specific pattern begins to appear. A classic technical formation known as the inverse head and shoulders. The inverse head and shoulders pattern. This is one of the most recognized bullish reversal patterns in technical analysis. It forms after a decline, and it signals that sellers are losing control while buyers slowly take over. The structure has three parts: a left shoulder, a head, and a right shoulder. In silver's case, the left shoulder formed in late January. That was the first major dip to around $74. Then came the real panic, the head of the pattern. That was the sharp drop to $64, a fast, emotional sell-off that shook confidence across the market. But then something important happened. Silver didn't stay down. It recovered. And now instead of making another lower low, it's forming a right shoulder around $75. Why the right shoulder matters. This is the critical part of the pattern, because the right shoulder is forming at a higher level than the left shoulder. Let's break that down. Left shoulder, about 74. Head, 64. Right shoulder, around 75. That's a higher low. And in technical terms, a higher low means something very specific: seller exhaustion. It means the bears are running out of power. Every time they try to push the price lower, buyers step in sooner, at higher levels, with more confidence. And that creates pressure against the top of the pattern, a level known as the neckline. The neckline, the real battlefield. For silver, the neckline sits between $84 and $88. This is the resistance zone that price must break to confirm the pattern. Think of it like a ceiling. Every rally so far has stopped around that zone, but each time silver returns there, the pressure builds. Because here's how these patterns work. The first test often fails. The second test weakens resistance. And the third test is often the breakout. If silver breaks above that neckline, the inverse head and shoulders officially activates. And when that happens, the pattern produces a price target, the measured move target. In technical analysis, the target is calculated using the vertical distance between the head and the neckline. In this case, head, $64, neckline, around $84. That's a $20 difference. So when the breakout occurs, that $20 move gets projected upward from the neckline, which gives a target of approximately $104. Triple-digit silver, not based on hype, not based on speculation, but based on a classic technical structure, the critical support level. But here's the important part. All of this depends on one level holding, $74. This is the line in the sand. As long as silver holds above 74 on daily closes, the pattern remains valid. The right shoulder stays intact, and the breakout setup remains alive. But if silver falls below 74 and closes there consistently, the structure begins to weaken, and the market could retest the $64 low. So right now, $74 is the most important level in the entire silver market. Not 100, not 80, 74. The hidden supply mechanism, the silver seesaw. Now let ES move away from the chart and into something more fundamental, because behind the scenes, there's another story unfolding. A mechanism some analysts are calling the silver seesaw, and it's happening in China. The issue begins with the Shanghai silver market. Official vaults there have reportedly been running tight. Supply is being rationed, and priority is being given to strategic industries, solar manufacturing, electronics, defense, electric vehicles. So the question becomes, if official supply is tight, why hasn't the price exploded higher? Where's the extra metal coming from? The answer, according to this thesis, lies in a tax loophole, the VAT loophole in scrap silver. In China, a value-added tax applies to large-scale silver transactions, but there's a small exception. If a recycler or small dealer sells below a certain monthly threshold, they can avoid the tax. That means small scrap dealers, jewelry shops, and electronics recyclers can sell silver into the market without the usual tax burden. And when official supply tightens, this scrap silver begins to flood in. Old jewelry, electronics, household silver items, all melted down, all entering the market at discounted prices. And this creates the illusion that supply is still plentiful. even when official vaults are running dry. But here's the key point. Scrap silver is not infinite. It's a finite resource. You can only melt down heirlooms once, you can only recycle old electronics once, and when that pool is exhausted, there's no backup supply. According to this theory, the drop to $75 was not caused by new mine production. It was caused by this last wave of scrap silver entering the system. A temporary pressure release valve, a final balancing act on the silver seesaw, and when that seesaw finally runs out of scrap supply, the argument is simple. Price doesn't drift higher, it moves vertically. Retail exhaustion, a hidden bullish signal. Now let's look at sentiment. Because markets are not just driven by charts and fundamentals, they're driven by psychology. One of the biggest signals recently came from a major dealer, APMEX. For weeks, they had order minimums in place, $500, sometimes $1,000, because demand was so intense. But after the recent drop, those minimums disappeared completely, which tells us something important. Retail panic buying has cooled off. The tourists are gone. The emotional buyers who rush in at the top have stepped aside. And in market terms, that's often bullish, because retail traders tend to buy the highs and sell the lows. They're the weak hands. When they exit the market, it becomes quieter, less emotional, less chaotic. And that quiet phase, that boredom phase, is often when large institutions begin accumulating slowly, silently, without resistance. So the shift from excitement to boredom may not be a bearish signal. It may be the fuel for the next leg higher. Now, let's talk about something controversial. Because while silver is forming a disciplined technical structure, another asset class is operating on a completely different narrative. Crypto. Recently, a major corporate Bitcoin advocate publicly claimed Bitcoin has no downside. No downside. Now paused for a moment. In 400 years of financial history, there has never been an asset with no downside. Tulips didn't have no downside. Railroads didn't. .com stocks didn't. Housing in 2006 didn't. Every time investors believe risk has disappeared, risk is quietly building. That kind of language. No downside is not analysis. It's belief. It's conviction turning into certainty. And in markets, certainty is dangerous. Silver versus the no downside narrative. Now compare that mindset to what silver investors are doing right now. Silver traders are openly discussing 74 as support, 64 as downside risk, 60 as a worst case floor. They are defining risk, respecting it, planning for it. That's humility. And humility survives markets. Silver investors know there is downside. They've mapped it. They've measured it. And that's exactly why they're positioned for upside. Because markets reward discipline, not delusion. Industrial reality versus digital belief. There's another difference. Silver has industrial utility, missile guidance systems, solar panels, high-performance electronics, medical equipment. It conducts electricity better than any other metal on Earth. That's physics, not narrative. When silver dips, manufacturers don't panic. They accumulate because they need it to operate. But when speculative digital assets dip, highly leveraged positions unwind. Margin calls trigger. Debt structures shake. One is grounded in physical necessity. The other depends on perpetual confidence. This isn't about attacking crypto. It's about recognizing that different assets behave differently under stress. And right now, silver's structure is calm, measured, and technically precise. The tactical battle plan? The next 72 hours. Now let's get practical. Because this is where strategy matters. There are 3 critical levels every serious silver trader should be watching. Level 1, $74. This is the line in the sand. If silver holds daily, closes above 74, the inverse head and shoulders remains valid. The right shoulder holds. The spring continues to coil. If 74 breaks decisively, then we prepare for a retest of 64, possibly even 60. But that zone, 64 to 60, would not be a catastrophe. It would be a generational accumulation zone. Why? Because that's near global mining cost, and historically, metals rarely trade below cost for long. Level 2, $88. This is the breakout trigger, the neckline, the ceiling that has rejected price multiple times. The third test is often the charm, and when 88 breaks with volume, the measured move activates. Target, $104, triple digits. Level 3, $60. This is the hard floor, the nuclear option. If we get there, it's not panic, it's opportunity, because that would represent maximum fear in the face of long-term scarcity. The risk-reward equation. Now let's talk math. If someone accumulates around $75 with a defined stop near 73, that S roughly $2 of risk. If the breakout hits 104, that's nearly $30 of upside. That's a risk-reward ratio approaching 15 to 1. You don't need certainty. You need asymmetric positioning. And right now, The structure offers exactly that. The psychology shift markets move in cycles of emotion: excitement, euphoria, fear, boredom. We've moved from excitement to boredom. And boredom is powerful, because when nobody is talking about it, when retail is left, when headlines fade, that's when accumulation happens quietly. The loud phase comes later, after the breakout, after the move, after the confirmation. Right now, the pattern is tightening, the range is narrowing, the spring is compressing, and compression leads to expansion. It always does. The only question is direction. Final verdict. The drop to $75 is not a crash. It's not structural failure. It's not trend reversal. It's a potential bear trap inside a bullish reversal formation. The silver seesaw may delay upside. Scrap supply may temporarily cap price. Retail exhaustion may create silence, but none of those forces change the core structure. Higher lows, defined support, breakout pressure building. The destination, according to this thesis, is triple-digit silver. The only variable is the path taken to get there. So the real danger right now isn't volatility, it's hesitation, not fear of downside, but fear of missing the accumulation window. Watch 74, prepare for 88, respect 60. And remember, in markets, discipline outlasts emotion, physics outlasts fantasy, and patience often precedes the breakout.